Where is it that somebody should be investing the money? What is the breakup? How do you balance the risk and returns?
Just to follow the old grandmother's thumb rule of saying don't put all your eggs in one basket, and you look around the world actually at the world's biggest billionaires, they actually make money through concentration and not diversification.
What is your portfolio allocation? Hi everyone, I'm Anup Gulati, Head of Marketing at PGM India Mutual Funds. Welcome to another episode of Money Buddy. In this episode, we are going to talk about personal finance, a fundamental topic of personal finance, which is asset allocation and diversification. So to discuss all these, we have with us Ajit Menon, CEO of PGM India Mutual Funds. So welcome back, Ajit.
Thank you, Anup. Happy to be here again.
Asset allocation, these are basically two words. The first word is asset. What is an asset? And what do you mean by asset allocation?
Well, I think that when you hear the word asset allocation, it ends up being a jargon for a lot of people, out there. They would have heard it on TV or read it in the newspapers, but essentially it's nothing but, how do you divide your investments and savings across different assets like real estate or gold or equity investing, and how many of those assets can you spread your money across? Just to follow the old grandmother's thumb rule of saying don't put all your eggs in one basket, I think that rule holds true here as well with your investment, which is that you try and spread your assets across income earning solutions or assets, which could be, like I said, real estate, gold, equities, and things like that.
Ajit, you talked about different asset classes, equity, debt, gold. Is there a framework to asset classes? How many asset classes are actually there according to you?
The kind of assets that you can invest into broadly 7 buckets, right? So one will behave differently from the other. That's where the value of diversification comes in, so that you can reduce your risk. It's not that everything is going in one direction, that you could get swung, negatively as well, right? Equity is one bucket. Deposits, debentures, bonds, all kinds of fixed income products are the second bucket. Third bucket could be gold and other precious metals that people invest into. Fourth bucket, I would say, is commodities. There are people who globally invest into commodities, not so much probably in India at the very retail level, but you have options to invest into commodities as well. The fifth is currency. The rupee, the dollar, the yen, the pound, the euro, and things like that. And again, there are people who invest and take advantage of that as well. So that's fifth. Sixth is real estate. I think that's very easily understood by a lot of people. And real estate can have, residential or commercial, or then land.
Old love of Indians.
Yes, it's an old love along with gold. And the seventh asset class is actually a catch-all bucket of many things put together, like alternate funds or hedge funds and venture capital funds, and you can even put things like antiques and luxury watches and wine and things, Bitcoin and things like that into this last bucket. I was reading somewhere that if you looked over the last 100 years and how people have made money, people would have made money in equities the best, right? And over that 100 years. And if you ask people, okay, what's the second? Most people tend to think, maybe it's real estate or maybe it's gold. The second asset class is actually wine.
Is it?
Right. So you can imagine, it's very interesting. I don't know how many people will be able to keep their investments safe and not drink it midway through.
Mutual funds as a category, how do they fit in diversifying somebody's portfolio?
Mutual funds is a vehicle to access many of these assets that you want to invest into. For instance, we all know that there are equity funds that invest into shares, right? So that's you're getting the exposure to shares there. There are mutual funds that just invest into government bonds or corporate bonds and other fixed income instruments. So you can get fixed income through it. If you were investing in global funds, for instance, which is also available in India for you to invest, you're getting an exposure to currency. For instance, many of those underlying funds would be denominated in dollars. So you're actually buying those dollars as well. So in a sense, you can get that currency exposure through that. There are some funds in commodities as well, not that it's very popular or that too many people use them. Gold ETFs people have heard of.
Yeah.
It's a very simple and easy way to access precious metal or gold and silver and things like that. There are also funds that package what's called REITs, or real estate investment trusts. So it's a way of getting exposure to real estate. These are listed securities, and I think that one of the advantages of mutual funds as a simple, convenient, transparent, very well regulated vehicle for people to invest into multiple asset classes. And I don't think that even though there are 7 asset classes that you need to do all of them to get some benefit, so to speak. In fact, Anup, I would say that it's very interesting when you look at wealth in general, and you look around the world actually at the world's biggest billionaires, they actually make money through concentration. And not diversification. So a guy like Elon Musk, for instance, has a lot of his wealth in Tesla and his SpaceX and all of the listed stocks that he has as a part of his portfolio, or Bill Gates with Microsoft and things like that. And we know about all of these individuals, and many of them have created a lot of wealth through concentration of just through their businesses, so to speak. But then those are outliers.
Okay, so now we have got the 7 asset classes. We have got diversification as a key to reduce or mitigate your risk.
Absolutely.
Because you can't eliminate risk completely. Risk will remain. But having said that, to mitigate, you can use diversification. But how is it that somebody decides how much has to go into what asset class?
Okay. The approach of the 3 bucket, to get how can you put assets into 3 buckets for the asset allocation that you want to do. Your first bucket is all of those investments that you put. So they are safe investments. They could be, some of them could be guaranteed things like fixed deposits and stuff like that, but they're largely fixed income sort of oriented.
So the risk is very low.
The risk is very, very low from a time frame perspective, as long as you have a time frame of at least 2, 3 months, 6 months and more, which is really very short term. I think you want to be safe. You don't want to lose your capital in any way. And so that first bucket ensures that you have that pot of money kept in fixed income, so to speak. Your second bucket should be the bucket which is like your lifestyle bucket, right? I mean, you want to live, you want to look around the society that you live in, and you have aspirations of the kind of car you want and the house you want and things like that. So your second bucket is really things that not just keep in pace with inflation, but create some wealth on top of it. And that's where equities play a role, right? It has risk, but if you have a reasonable time frame, and I would define that time frame to be at least a minimum of 5 years and beyond, you could use equities into that second bucket, because it will give you that return and that ability to create that little bit of wealth so that you have a lifestyle that you can keep up with. I think the third bucket I would define as the lottery bucket. Right? Everybody has an aspiration to make,
quick gains,
good wealth, and call it quick gains. I think that it's just human to sort of speculate or take that risk. And that third bucket is really where you might want to really concentrate, put some money into some sort of venture cap fund, or, put that into one single stock of a company that you think will do extremely well, maybe a painting or even Bitcoin, right? That could be the risk that you're taking. I think, Anup, the important thing, however, in this 3 bucket approach is to always remember that that third bucket, that lottery bucket, should be something where you're okay if you lose all your money. Right? But if you make money, you probably make well. And therefore, I would probably say that you got to keep that third bucket to, say, 5% of your total portfolio, right? You can make a bet with 5%, because if that 5% goes to 0, your 95% is going to catch up. Within a year or 2, it's going to catch up. So you're not going to be worse off. I think mistakes that people make is when thinking of that speculative approach and thinking of that quick money, they do more than 20-30% of their portfolio into things where they're taking just a punt or a bet, and then that can obviously derail your sort of financial plan. So when you think of the asset allocation and you think of an approach on how to maybe do this, I think it's about deciding that, okay, I'm going to have maybe 30-40% in the first bucket of safe investments. 40-50% in that equity
Second
bucket
bucket,
for my
lifestyle.
lifestyle,
Yeah.
and then maybe a 5 or 8% that I'm comfortable with into that lottery bucket where I want to just go out and do something where I think along with my friends or from whatever I'm reading, I want to take that bet. And that I would say would be a sort of simple framework to think about.
So it's quite interesting actually. And I was thinking that the moment you start striking gold with that lottery bucket of yours, 5% becomes 7, 8% or 10%. As human beings, we tend to get greedy and we tend to put all the more money into it. So how does somebody take care of his behavioral aspect? How do you control yourself, for example, on not to go overboard with those buckets?
Well, it's very, 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 very difficult, but not impossible. So I must tell you that, one of my favorite sort of heroes, so to speak, in the economics and finance world is Daniel Kahneman.
Okay.
He's a behavioral economist. He won the Nobel Prize for behavioral economics in 2002. It was Daniel Kahneman and Amos Tversky who sort of brought the concept of behavioral finance and behavioral economics to the world. He did leave us with one simple thought, which is that when you're managing your money and you know that there are all of these human biases that can affect your decision making, make sure that you have somebody trusted who is in a different emotional state than you. Because it's your emotions that sort of put you into that space where you could end up making a mistake, getting more greedy or getting more fearful. So you need somebody who is in a different emotional state than you. And to me, I think that's my financial advisor, who I know is competent enough to think about, what my defined goals have been and what my portfolio is, and to sort of handhold me during times of either market disruptions or anything that happens to make sure that we are on track. That's the biggest value that a good financial advisor really brings on the table.
What is your portfolio allocation?
I would say that if I looked at my assets in the way that it is, I'm about 60% in equity right now. Equity funds, all kinds of equity funds. And this includes maybe about 5% of international funds as well. But 60% in total. So that little 5% gives me that currency exposure as well. So I've got equity funds and some of them are diversified funds, some of them are balanced funds, or all types of that. It's very easy to do that. So 60% is in equity. I've got 20% of my net worth in real estate. That's 80. I've got about 17% or so in fixed income. That includes my emergency funds and any near-term goals for which I might need to withdraw, money for my kids' education, their fees and things like that. So I have about 17% there. And the balance, about 3%, is in gold. ETFs, largely, not physical gold, but ETFs. That's my sort of overall asset allocation.
So this is it on this episode of Money Buddy. Till the next time, thank you. Keep investing.
Money Buddy podcast brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.